Thanks for coming back to the latest episode of the Credit Clubhouse. We are your one-stop shop for all things credit. Before we jump into our next episode, we have an exclusive offer for our listeners. If you're interested in attending any of our conferences throughout the year, we have a great deal for you. Just head to www.dealcatalyst.io, pick the event you want to attend, and enter the promo code CREDIT at checkout. This will give you 10% off any ticket to any conference. As always, don't forget to follow the show, rate us, and leave a review. We encourage your feedback. It'll help us make these episodes a better listen for you. And now, on to our next episode. Welcome back to our latest installment of the Credit Clubhouse. As always, I'm your host, Todd Anderson, Head of Content and Programming at Deal Catalyst. Joining me today is Edwin Wilches, Managing Director and Co-Head of Securitized Products at PGIM. Edwin, I really appreciate your time. Great to have you on the show, and obviously great to see you again.
Yeah, likewise. Pleasure's all mine.
So, starting a bit higher level, maybe from a macro standpoint, to what extent is the current climate, geopolitical, macroeconomic kind of uncertainty reshaping investor appetite and what they're thinking of when it comes to, securitized products, ABF, from the seat that you're sitting in?
Yeah, it's a great question. I think, look, a couple things are happening kind of all at once, right? In some regards, it's like it's the best of times and it's the worst of times as fixed income investors, right? On one side, you have fairly attractive yields that we haven't seen in decades. At the same time, some asset classes are near or at generational tights of spreads. So good news is you're getting more yield than you once were. Bad news is the compensation for risk is quite narrow. As you start thinking about just the investment options for investors, generally when you think fixed income, most folks immediately think about either corporate credit or sovereigns, right? So treasuries and other things like that. As we're seeing more and more investors rebalance their portfolios, again, with the backdrop of, despite the wall of worry on the macro side and the level of uncertainty in general, we are seeing, stocks, equities, real assets, commodities, digital assets all hit all-time highs. So investors need to rebalance, and fixed income is a place where they do that. When you think about it that way, investors have a deep desire to diversify. So as their fixed income portfolios are growing, we're seeing a fairly meaningful focus and attention on all securitized. Whether that's things like just CLOs, which is now, as you know, a very large market. There's ETFs. It's kind of a bit more consumable, if you will, to things like more diversified securitized credit funds, and as you mentioned, obviously ABF, both investment grade and below investment grade, are quite something that investors are quite focused on as well. So I'd say it's really broad. It's really all investor types. It's pensions, it's insurance, as I mentioned, retail, sovereign wealth funds. And the trend, Todd, is global. When I have the pleasure of working with clients overseas, in Asia, they've been a large investor in U.S. markets, but even places like Europe, we're seeing quite a bit of expansion into securitized. Mario Draghi, about 18 months ago, or I guess almost 2 years now, put out a report on the need of Europe's growth to include securitization as a part of the funding source. So I'd say it's for a variety of different reasons, securitization is a place where clients are really, really focused. Again, it's yield, diversification, and scalability, because we have a lot of issuance.
So there's been a lot of discussion, and it feels like recent months, but probably the last couple of years, when it comes to private markets beginning to look like public markets and vice versa. You're hearing the premium in private markets beginning to erode a bit. Where are we when it comes to that public versus private and kind of the lines beginning to blur debate?
Yeah, so I mean, we definitely see convergence of public and private markets happening all around us. The most obvious place, or the one that's most at least commonly thought of, is in high yield, right? So when we think about like the broadly syndicated loan market and the private credit or direct lending market, that's an area where we're seeing clear statistics around, X number of companies were left the bank loan market and went to the private credit market and, vice versa. So that's an area where we continue to see that. And I suspect that trend is going to endure. So I don't think that's changing. We're seeing quite a bit of convergence as well on the corporate side, right? We're seeing the rise of like what I'd call structured corporates, but the rise of like some of these big investment grade complexes looking at more ABF ish or private IG solutions to fund their capital structures. And sometimes it's because it's kind of unique sources or unique uses of capital, and they don't want to issue general corporate purpose debt. And then in ABF, I mean, it is the convergence is full on. We're seeing the large established issuers across everything from consumer, commercial, um, and even CRE look at diversifying their funding sources. So thematically, a lot of these companies are like, okay, I can maybe source some debt or source part of my balance sheet from the public market. And that could even be unsecured bonds if the companies are big enough. And then, I could use securitizations as a way to fund my balance sheet. I'm going to use bank warehouses as a way to fund my balance sheet. But then also, increasingly, with the rise of ABF, I can also do forward flow agreements, or I can do spot sales, and I can now have, call it a third or fourth lender type to help finance my business through cycles, right? I think COVID really, like the shock on the system of some folks pulling back very quickly, or other folks just kind of turning off capital markets activity, really underscored the need of multiple funding sources for many CFOs, and I see that as a trend that continues. Now, in terms of spread, I think we're definitely seeing. I think what you don't want to some degree is it makes sense that the convergence of public and private and kind of the power of having kind of one credit view and kind of seeing the whole market in terms of being able to price risk. The challenge is when spreads start to converge too much, and you start losing the that premium. Look, I think in corporate credit, there's still a healthy premium, although it definitely has converged quite a bit. And I suspect, look, I mean, I think as until we get a healthy M&A cycle and we get a lot more issuance in leverage finance in general, my guess is that pressure, between kind of the different lender types, whether that's high yield bonds, BSL bank loans, or direct lending, those tensions are going to remain, and those spreads are going to continue to compress. The one place where we're not seeing that as much is ABF. And it's really just because, from our perspective, there is a real supply and demand imbalance between kind of the need for capital and just the supply of it. The numbers that we hear around different folks range from we think it's somewhere close to 10 trillion of a target market. There's estimates that are as high as 40 trillion. But
Yeah.
the point there is that there is a lot of need for financing right now, even though it always starts to feel a little crowded once more and more folks come into these markets. We're still far away from having a dearth of investment opportunities on the ABF side, which I think has kept pricing pretty competitively. We're seeing that liquidity premium, whether we're talking about investment grade or below investment grade, to be pretty healthy. There's exceptions, like anything else in the market. Whenever there's periods of extreme fundraising in any one specific asset class, we see spreads get compressed there. But candidly, it's such a broad array of assets and financing needs that as a diversified investor, we can maintain pretty healthy, illiquidity premiums, because we don't have to just do one sector.
Yeah. So when it comes to your remit at PGIM, what does your role cover? Where is PGIM focused today? And ultimately, how do you stay differentiated in an environment that is getting more competitive by the day?
Yeah, at PGIM, we're obviously a global credit manager. The broader firm manages a bit over $1.2 trillion across credit. I help co-lead the Securitized team, which is about 150 billion of AUM globally. That includes both public and private investments. So on the public side, think of things like CLOs, CMBS, RMBS, and consumer, commercial, and esoteric ABS. And then on the private side, it's really what we're now colloquially calling ABF, which includes a lot of different variety types, asset types, but it'll include things. It rhymes with the public side, in terms of consumer related assets, commercial, fund finance, hard assets, real assets, mortgages, things like that, are all part of the team. We have about 40 folks on the team, so it's a pretty large investment team. As I mentioned, it is global. So we're very fortunate to be able to kind of have a pretty broad view of the investment opportunities. To answer your question, Todd, across all these businesses, whether we're talking about, again, I'd say something deeply private and bilateral, which we're quite active in on the ABF side, or something like our AAA CLO ETF. One of the competitive advantages, I mean, there's a handful of things that are really critical, but high level, outside of depth of analysis and kind of having a good sense for rel val. And again, I think the more you see and the more you analyze and the more you assess, the more efficiently you can price risk, which we think is really, really important. Obviously, especially markets like this where it's hard to differentiate just based on purely spread, because things are kind of on top of each other. But I think origination is a really big part of all this. So if you think on the private side, that is a very common way of clients asking us, really, like, okay, so I'm going to assume you guys have a good team, and I'm assuming you have good track records, and you'll have great technology and great process. The key part is really origination, right? Is it unique? Does it diversify me further from any existing investments I may have? And then, as I start thinking about just allocating to an asset class, how do we build a portfolio, and how do we make sure we don't get overlap? On the public side, right? So I think of even like I mentioned, CLOs. I think it's actually sourcing as well, right? So on the public side, we call it sourcing. On the private side, it's called origination. It's all predicated on the same principles, right? You have built relationships over decades. You're commercial, and that doesn't mean that there isn't points in time where you have to do what's best for your client. But I think everyone kind of understands that. And from our perspective is our ability to source assets, whether it's in the primary market, whether it's in the secondary market, being able to source liquidity for clients when they ask for it, or being able to source liquidity when we want to do relative value trades. I think there's a ton of value that active managers can add in securitized. Again, credit work, teams, technology, I'd say to some degree that's table stakes, right? Like you need to have a lot of resources to do securitized well. But then to kind of put you over, the edge, it's really about, do you have that sourcing or that origination? At the end, when we were thinking about our broader business, we thought it was really important to have one team, one business. It's, public and private is together. It's one analyst team. So whether you're talking about a, public student loan pool or a private student loan pool analysis is going to be the same. The way you get information might be a little different, but the analysis is going to be exactly the same. And I think having that, again, that rigor of having one team is really important. And then, as I mentioned earlier, as all these firms are looking to diversify their funding sources, PGIM is a pretty important and powerful partner where we have differentiated sources of capital, right? So with $150 billion of AUM, and a variety of different client types, we're able to be pretty meaningful across the gamut in terms of investment grade, investments, below investment grade investments, global, public, private. It makes those discussions about partnerships and relationships, again, which hold true for public and private, uh, pretty powerful.
When it comes to, the securitized products, what are some of the biggest shifts you've seen in investor appetite and, say the last couple of years? And is any of that changing, or what can we expect heading into 2026 as we kind of get towards the latter half of 2025?
Yeah, and I'd say the shifts are probably a little different depending on who we're talking about. But there's always kind of been like a bit of a continuum. So I think, for many years now, maybe a decade, clients have generally been a bit more comfortable with CLOs. Again, they've had kind of corporate credit in their portfolios. It's kind of a little bit easier to understand or analyze or kind of get your arms around. And we've seen clients, either continue to increase their CLO allocations, or maybe start thinking about, going further down the capital structure, or mixing in other types of securitized. We're definitely seeing clients increase their portfolios into broader securitized product offerings. So, there's been an acknowledgement. CLOs have been cheap for a long time, but as other asset classes have continued to grow, things like Resi and CMBS, those markets have changed pretty meaningfully in the last 10, 15 years. So really post GFC, these markets have evolved dramatically. And it's hard for allocators and clients to time the market or know what's cheap at any point in time. So they're increasingly looking at at us to help them with that. Some folks still want to have a core CLO allocation, and then they'll have like a satellite securitized product mandate. In other places, insurance continues to use securitized quite a bit. Again, they're not just things like CLOs, but definitely ABF is something that is quite attractive for them. When I think about Asia, again, similar themes as many U.S. investors, where CLOs have been a focus. I'd say increasingly lately, we've been getting a lot more inquiry for mortgage or even consumer related ABS and RMBS. So that's an interesting development. And then in Europe is probably where we're seeing the bigger changes, or maybe arguably the biggest changes. And it's twofold. One is, we think that market is poised again to grow, as I think regulation will be right sized a little bit. 17 years post GFC, but also clients there are realizing that the available universe for a European investor, and again, they have different risk retention rules in the US, so their opportunity set is different. If we look at all securitization, it's about $5 trillion, that a US investor can kind of buy. When you're in Europe, that number, if you're only focused on Europe, is about 500 billion. When you open up to the US, most are surprised to learn that about, call it 20% of the US is actually EU risk retention compliant. Now, the US is about 5 times the size. So I won't make you do any math there, but basically what it means is if you have a global portfolio, you literally more than doubled the size of your investment universe. So we're seeing quite a bit of interest as well from European investors looking to do more global mandates.
And are
So again,
is some of that due to the kind of uncertainty here in the US? Tariffs might be on today, they might be on tomorrow, or what trade war might happen. I mean, has that increased the appetite for people to look at opportunities in Europe than say a few years ago? Or is it, kind of a natural evolution that, the market has changed a little bit, 17 years post GFC, things are opening up maybe a little bit more than they used to. Is there any particular reason why Europe might be having say, a bit of a moment today?
yeah, I think a lot of it is just a deep desire to continue diversifying.
Yeah.
The beauty about securitization in general, and whether that's any sort of corporate stress or even things like tariffs, right? Like given the general high levels of diversification that most securitized products have, and obviously CLOs are pretty highly diversified. Even tariffs, right? Like you're going to have some spread movement because you're a spread product. But when we looked at excess returns in April of 25, CLOs actually have performed exceptionally well relative to corporates, in large part because it's a diversified pool, and there's some
Yeah.
companies that aren't impacted, some that are. And when we're looking across the world, I think that's definitely true. Right, the more diversified your portfolio is, the more shock absorbers you have, because where one thing maybe doesn't work as well, in other places it might. And as we're thinking about portfolio construction, we have exposure to real assets through a mortgage, whether residential, commercial assets. We have lease type assets around commercial ABS, where you have consumer, which is generally pretty short, and then we have CLOs, both in the US and Europe. When you kind of put all that together, you have a nice kind of cross section of the economy, where if maybe the consumer is not doing as well, or rates are going up, you're going to have the real asset part of your portfolio, your mortgage portfolio, doing pretty well because assets are stable. Home prices have gone up, right? So there's a lot of like portfolio construction things that I think us as investors think through a lot, but also our asset owners, our clients, are really thinking a lot about diversification. And again, the noise and the macro is everywhere, right? I think there's countries in Europe right now that don't have a government, right, and they're kind of going through
Yeah.
their own cycles. So I think it's not unique just to the U.S. I actually think it's a pretty global concern.
You referenced certainly the ABF and kind of in particular, the demand by insurance companies and others for asset-backed credit. Is there anything, driving that demand? Is it just chasing yield? Is there more of a structural shift as they look at more illiquid collateralized assets? Like, it feels like ABF is, obviously you said 10 trillion, there's been as high as 40 trillion. Is there anything in particular there beyond just, obviously diversification? But is there anything within those asset classes that make them even more, interesting?
Yeah, I mean, I think diversification drives a lot of it.
Yeah.
I think obviously yield premiums and that liquidity premium helps a lot. There's a few things, right? I think one is many private credit investors in particular on the corporate side, right? There's kind of some irony, right? In one case, if you have a private equity portfolio, you're a frustration these days, and one investor called it the IRR recession, right? Like the distributions are quite low because there's not a lot of
Yeah.
M&A. So on the PE side, you're not, you kind of wish you got money back. On the private credit side, and again, I think this will get even more challenging as wealth starts to come into some of these assets. There's a gap between deployment and commitment, right? There's only so many companies that want to borrow,
Yeah.
and two or three healthy markets, right? Bonds, loans, and direct lending that would love to lend, right? So there is a gap. So, insurance and everyone else is also saying, oh, look at this. This ABF is diversifying, gives me really interesting yield, and is scalable. I could actually invest in it, which is pretty critical. But the other piece, Todd, is that a lot of these assets that banks are now lending less to, right? So I'm talking about especially the assets that insurance companies are looking at. These are assets that banks, regional banks were quite active in. Post SVB, just regional banks in general have to hold more capital. I think bank balance sheets are managed a bit differently, and the consequence of that is that there's a lot of investment grade type assets that were once held at banks that now the banks are choosing to or can't lend against. So, I'd say in the last 18 months, the availability of investment grade assets in the private market has increased substantially. And again, so it's not, immediately post GFC, when you think about kind of what was the first regulatory step, right, was at least for some of the banks, was to get rid of all the risky stuff, right?
Yeah.
And by the way, the reason we call it bank loan market is because it was loans made by banks to corporate America. And like
Yeah.
these days, those loans are nearly, it's very, very small part of lending that banks do. And all that moved to the private market, right? Whether we call that BSL or direct lending, it's not banks, right? You kind of keep this evolution going. You have kind of subprime consumer ended up away from the banking system. You had things like aircraft leasing outside the banking system. So the like the credit risky stuff had left the banking system. Now what we're seeing in the last 24 months is the high quality stuff also doesn't sit well with banks anymore. So that creates an opportunity for investors, especially folks that can give liquidity, like insurance
Yeah.
companies, to now be able to access really high quality assets that are financing the real economy. So it's not just corporates. So again, it's like a true diversification. I'm not talking about volatility or diversification in like the math sense. It's just fundamentally a different asset, different cash flow. And I think that's really why you're seeing so much focus, is why we're hearing so much about ABF, is because there has been like a real need for the market to come in at a time when the market needed assets. So it was a perfect marriage of, one side, the economy needs funding and asset owners need assets. So I think that's why we hear so much about, ABF in particular.
When it comes to, kind of structural changes, innovation taking place, I mean, what are you seeing today, or what is, exciting you most about kind of some of the changes around, structure and innovation in some of these either transactions or just in how things are starting to come to market today?
Yeah, I think with regards to, investing itself, I guess always the thing I love about being an investor is, there's a ever evolving kind of, opportunity set. There's always new things to learn. I mean, topically now, right, we're talking a lot about data centers and AI and the
Oh yeah.
hyperscalers and, all things like that, right? Those are all things that are just intellectually stimulating to say the least, incredibly challenging, but quite fun. So I think from the asset side, that's something that's always changing. So I don't know if I necessarily call that, so much, it's an evolution. It's kind of just more steady change, which is good. So not innovation, but rather evolution.
Yeah.
I would say, from a pure securitization perspective, or even ABF, the innovation is actually pretty low, like in the sense of, I like to joke, right? PGIM was actually did the first music royalties deal. Okay, so this is how far our ABF platform goes. Again, we didn't call it ABF back then. That was in 1997. And
Wow.
and they're colloquially like called the David Bowie bots. Right. So that was us, right? So is that product innovation? No, it's lending that had happened decades ago, that was sitting in some places, and now it's kind of back in investor portfolios. But I'd say that part of the innovation hasn't been that different, candidly. It's still similar structures, loans, forward flow. Again, these are all things that have existed for a while. Where we're really seeing innovation, and I do think this will continue, is more in the way that our clients consume some of these assets. So, when you're thinking about retail, obviously a massive
Yeah.
innovation has been ETFs. ETFs work really well for very liquid, high quality products. AAA CLOs, perfect.
Yep.
They work a little less well for things like that are more private in nature. So what we're seeing quite a boom in is interval funds. We've seen a
Mm-hmm.
lot of growth in BDCs over the years. Again, these are all retail products that are more semi-liquid, so they're open for you to invest, but you need to have a longer investment horizon because the redemption terms are limited, right? It's not like a mutual fund or an ETF. On the private credit side, again, whether this is corporate credit or ABF, we're also seeing institutional investors, pensions, sovereign wealth, increasingly start to consider evergreen funds
Yeah.
versus closed-end funds, right? So historically, you had a kind of private equity style fund where you did a raise and then you invested the capital. Maybe you had some reinvestment or some revolving, and then there was a harvest period. The increase of evergreen is also quite meaningful, and we're hearing a lot from clients in terms of just product development, with regards to how they consume assets. And then, on the insurance side, one of the things that has definitely grown in popularity has been things like, rated feeders and collateralized fund obligations. And again, these are all things that are trying to solve different problems for end investors. But I'd say the real innovation has really been mostly on the product side. And what it's done, it's helped meet clients where they are in terms of what they need for their investment goals,
Mm-hmm.
and give them wrappers that can house some of these assets in an appropriate way to match liquidity.
When it comes to retail, I mean, there's been obviously the White House made an announcement around 401ks. I mean,
Yep.
how much access should the retail investor have to some of these more private assets? I mean, obviously the information is not the same as you would get in your typical public asset classes. I know more people are thinking of ways to, private credit access for to retail investor. I mean, they shouldn't have the equal amount of access as say an institutional investor, right? Or I mean, should retail have the same access?
I mean, I think a lot of the access is really done through an asset manager. So it's not like, they're buying an individual stock. They're
Yeah.
not buying an individual corporate credit or private credit or anything like that. So I think, that's a positive. I mean, look, longer term, we definitely have seen, private credit add value to institutional portfolios. So I do think it makes some sense to have some availability for retail to also kind of have the ability to invest there as well. I mean, I think again, ultimately, it's really more about what I suspect, Todd, is a lot of it is still like the focus is really more on the wealth channel rather than starting to see fonts pop up on the in the Sunday paper in the back. I'm not dating myself, but you know what I mean.
Yeah.
So I think it's still probably done through some financial intermediary that's a professional investor that's hiring asset managers to do it on behalf of their clients. To me, the question is always like trying to match your time horizon, right? If you're a 30-year-old with a 401k and you can bear some of the risks of private credit or stocks or private equity or infrastructure. I mean, I think there's real value to that, but you have to understand that you're not going to get your money for at least in a 401k, right? Like none of us expect to really tap that until you're well into your 60s.
Hmm.
But I think there's definitely appropriate levels of private assets. Again, I think, look, I got to tell you, like, there's some pretty, complex in my opinion, right? Like bank preferreds are quite complex and AT1 securities are quite complex. And just because it's not structured or private doesn't mean it's not tough to understand.
Yeah.
So I keep going back to, I think it makes sense to have the ability to do it, and then how the end consumer, chooses to utilize it is really, critical. Todd, look, and this is something that comes up in Europe a lot, because in the US, it's easy for us to buy stocks, right? Like we really
Hmm.
have an easy way. For Europe, it's quite hard, actually. Many will say it feels like I'm taking a graduate level test, just to, with all the disclosure. But on the flip side, buying crypto is easy, right? And the
Yeah.
question is always like, it's never a straight answer, right? But I think
Hmm.
it makes sense, to give some capacity for the retail investor to participate.
So a couple more questions before we get to a few fun questions and wrap up shortly. I mean, there's been a lot of capital raised, and it feels like a lot goes to, and no disrespect, obviously the PGIM and Blackstone and many other large names, but is there a concern that too much is concentrated towards the top, and will this kind of either discourage new managers from starting or hurt the smaller or down market managers? Because there needs to be obviously a balance. You guys aren't going to underwrite a newer, originator or specialty lender versus someone else that might do it. Is there a concern too much is being concentrated towards the top end of the market?
It's interesting. I recently was talking to some LPs about that, because we're definitely seeing, what I would describe as, scaled capital is really kind of winning the day, right? And
Hmm.
you asked earlier, how do you differentiate? And on the private side is origination, on the public side is sourcing, amongst many other things, obviously.
Yeah.
But those are critical parts of it, and the only way you can be really successful there is with size and scale. And I think that's going to continue. Now, when we were chatting about this, one of the folks I was talking to made a point about, they had, been quite focused on hedge funds, right? And that was always the question, right? Like, was AUM the enemy of performance? And I think, what we've seen recently, is some of the largest hedge funds in the world are actually doing the best. And I think, again, it's kind of the scale point. So I think there's, from what I hear from our clients, and again, I actually ask this question quite a bit, because it is something that's important, structurally. It almost seems like, again, even our LPs, right? So maybe they'll hire PGIM, and then they'll consider someone that's more niche or more focused on a certain strategy. But again, that's increasingly getting hard because the relative value moves so much.
Yeah.
They're scared of getting stuck, but let's just continue down that path anyway. The way that this LP was framing it for me is, we're going to have a large portion of the portfolio in scaled multi-sector, multi-asset managers, and that's going to be a healthy bulk. But then we'll also have, our niche strategies, and to your point, maybe, some of the, different types of lending that's happening in the economy. And I think get where it really gets tough is being in the middle, right? Where you're a little too big to be niche, but you're too
Yeah.
big enough to be scaled. And I think that's where you're going to just see GP consolidation or asset manager consolidation, or the need to have partnerships in order to kind of remain relevant. So I think, there's going to be room for both, but I do think it's almost like, the niche strategy will win at times. I think the scaled strategy will have a lot more durability. But if you're somewhere in the middle, I think that's probably where, I suspect we'll continue to have, M&A in asset management. And we're seeing it, right? I mean, we're seeing it in ABF players, specialty lending finance folks
Yeah.
that were incredibly successful businesses that are finding it harder to compete with scaled capital. And then, even in CLOs, right? We're seeing, those smaller managers at some point, if you can't keep up with issuance, maybe because of performance or turnover or whatever it is, at some point you start getting consolidation.
Last question before the fun ones. Is there any particular sectors or geographies that you expect to outperform in the next few years?
Oof, outperformance. I think, I mean, it's gonna evolve. I do think ABF is right now is commanding quite a bit of a liquidity premium. So I do think that again, that's quite durable. So when I look at, just about every opportunity set, that if you can give liquidity, ABF is presenting some great opportunities again, and fairly diversified. When we look at other asset types, I mean, right now, given how tight spreads are, and where we're seeing compensation for taking more and more risk, I'd have to say it's going to probably be the senior parts of the capital structure are going to do better, just because they're still capturing quite a bit of the spread of the
Mm-hmm.
underlying asset. And we will have volatility. We will have a recession at some point. And given where prices are, if you believe in mean reversion in fixed income markets, when you're at generational tights, and you have 100 basis points to move, just to get back to average, getting back to average is going to be a little painful. So I do think things like CLOs and resi in particular are asset classes that are set up to do fairly well, and relatively speaking well, because spreads are still kind of average, so they're not at generational tights, and that spread compensation is going to be meaningful. And in again, Europe, I think will have also its kind of day in the sun, with regards to just having growth in that market, and hopefully some GDP growth as well.
So some fun questions as we get to wrap here. Favorite sports teams, or indoor hobby?
Ooh, um, I mean, I grew up in New York, so I've been a tortured Knicks fan for a really long time. I was so much a Knicks fan that there was probably a period of like 6 years that I stopped watching basketball because I was just crushed as a kid, watching us lose back to back. Yankee fan, so that's always a fun roller coaster. Giants fan, that feels like a one-way train. Uh,
Lately you're starting to, it feels like you're back on the up
I
slope.
don't know,
Though
man.
after last week's game, I can
This,
understand how
this
it crushed you at the end.
yeah, I had lost my voice before it felt like the week started. But no, look, in terms of hobbies, like I love reading, I love spending time with the family. I'd say like I'm much more of a homebody than people realize. But I just love being around family and friends.
One surprising thing about yourself.
Ooh, that's a good one. Surprising. Maybe that I'm a homebody. A lot of folks think I'm probably less extroverted than people expect or people think. But yeah, maybe that's it.
One book that you would recommend reading.
Ooh, book. One of my favorite books, ironically, it ties into sports and team, is a book called Legacy, James Kerr. I'm actually not a rugby fan, but it talks about the most winningest team in all of sports history is the New Zealand All Blacks. And it's a book on leadership, and there's a few themes in there about the importance of culture, the importance of humility. There's a term there, sweep the sheds, where it's like even the star players, clean up after themselves. They always talk about leave the jersey better than you found it, right? Kind of this
Hmm.
concept of making your mark. I think it's a great book. I'm not a fan of rugby, not maybe I just haven't watched the right one, but it's a phenomenal book, on leadership and teams and winning.
Most exciting part of your job.
Ooh, you know, I really got to say there's two things I love about my job. One I mentioned earlier is just the um, endless, continuous kind of learning in terms of different asset classes, different things on the market, different perspectives. To me, that just keeps it super duper fun. As I've matured more in my career, one of the things I really love about my job also is just watching the team develop. Having folks, come onto the team, figuring out what people are good at, pushing them, maybe pushing them to where as a manager, I know they can be, and maybe they don't see that in themselves. And seeing that happen is very, very rewarding. So I really do love kind of the team piece of it as well. It's really cool to see people grow in their careers and their knowledge base, and kind of develop a passion for things that they're really good at.
And final question, one prediction for the next 12 months.
Prediction. Ooh, so 12 months is a tough time, Todd. I think, for me, it feels like, we have pretty good tailwinds, notwithstanding kind of idiosyncratic noise that we kind of keep hearing about. Seems like, the Fed's going to continue to be, fairly accommodative. Regulation is generally, favorable in terms of kind of the administration. Data center growth is very real. It's adding anywhere between a half to three quarters of GDP growth has come from data centers. And when you think about all this construction, it's not just construction, it's all the jobs. You need maintenance folks, security folks,
Yeah.
building. It's very real. I think that's going to continue for the next 6 to 12 to 18 months. I think after 18 months, it's going to be a lot more challenging, in terms of kind of when all this CapEx is spent. So I think, for the next 12 months, I think we kind of keep muddling along. I mean, there'll definitely be periods of vol. That's almost certain. But, it seems like we're in an environment today, at least, where markets are pretty supportive. And I think, it actually makes investing really tough because spreads are pretty tight, and the compensation for the unknown isn't what it used to be. But I think, looking out, so maybe 12 months from now, I think that the picture gets a little bit more challenging. And it'll be really interesting to see how everything ends up, right? I mean, we're still waiting to see what the true impact of tariffs are. We're still waiting to see how these wars globally develop. There'll be, I'm sure, some in 2-3 years, there'll be another election cycle. So that,
Yep.
is going to bring a lot of interesting things. We'll have a new Fed chair. There's just a whole lot of interesting things on the come. So I think it's going to be more stable, than people fear. But I do think the outlook going in the outer years is quite a bit more challenging.
Well, I think that's a good place to leave it, Edwin. Thank you very much for your time. Great to see you again, and obviously continued success to you and the team.
Likewise, and I have become a new podcast listener of the show here, so looking forward to all the future episodes.
Well, thank you. Thanks for coming back to the latest episode of the Credit Clubhouse. We are your one-stop shop for all things credit. We have an exclusive offer for our listeners. If you're interested in attending any of our conferences throughout the year, we have a great deal for you. Just head to www.dealcatalyst.io, pick the event you want to attend, and enter the promo code CREDIT at checkout. This will give you 10% off any ticket to any conference. As always, don't forget to follow the show, rate us, and leave a review.